Hello, welcome to a Wealth of Advice market update on Monday the 18th of July. Obviously bringing this update to you after quite a few weeks of market turmoil, market volatility, markets going down in value. There's no hiding away from it. Obviously when we do these updates, we're coming to you to try and reassure people about what's going on in the investment world, and I have to 100% categorically say right now things aren't the best they've ever been. Things aren't good, but I am still positive as to where things can head, provided certain things start to happen. The main focus of what we're going to talk about today is inflation and how that's had such a negative impact on markets, and what is the cause of inflation and how governments will overcome that, and what strategies are in place at the moment. And we are hopefully now starting to see the really high inflation start to plateau off. The next step in the process of getting markets going up again is if inflation starts coming down and a correct policy decision comes through, then markets may like that. So in market news, I'm going to try and start off with hopefully something positive. Been to lots of fund manager events over the last few weeks and months, and the general consensus of opinion in the recent weeks is that the UK is now in recession. A recession is defined as 2 consecutive negative quarters. The first quarter of this year, GDP rose by 0.8%. So April, May, June would have to be negative, and then sort of the next 3 months after negative as well for us to be in recession. The figures that came through for May have actually surprised lots of analysts. The prediction was that best May was going to be completely flat with zero growth. There was a decline in April of minus 0.2%, but May was actually up 0.5%. So provided the June figures, which will be released in August, show something more positive than minus 0.3%, then that won't be a negative quarter. And then this recession may not be here. Now, markets haven't really sort of responded in a positive way to this information, because at the moment, everything that's out there in the news, it just seems to be negative. And inflation is the main sort of problem. How is it going to affect the price of goods and commodities all over the world? How is that going to affect consumer spending? And more importantly, how does that affect consumer confidence? And a lot of the reports and such like that we're reading is that consumer confidence is really, really low. The consumer has stopped spending. The consumer is sitting on their cash and saying, well, I'll wait to see what happens next. The war in Ukraine, Brexit, what's going on in the US in respect of its own inflation, plus 9.1%. These are all negative factors that are causing inflationary problems. China still having lockdowns in certain parts of the country, which is starting to ease, by the way, but I think certain parts of China are going to remain in lockdown till August. That's all inflationary. We have a client not too far from us who was waiting for an order of some goods from China at the beginning of the year, which he knows that once he receives those, he'll be able to manufacture them and then sell them at a profit. He can't do that until these goods come. So that's inflationary in the sense of if he wants to buy alternative goods, he's going to have to pay more for them from somewhere other than China. So once that can be resolved and we move into the second half of this year, hopefully inflation starts to come down. The UK rate of inflation is around about 9%. US inflation, we hope, has peaked. That was 9.1%. And as you can see from the first chart that we're putting up there, right at the very top of the graph, you can see how quickly it's spiked up. It is starting to plateau off, and this is what governments need to do next, is try and bring inflation down. How do they bring inflation down? Well, they have to increase interest rates. By increasing interest rates, you cut off or reduce demand. In the UK and in the US, why markets have fallen so sharply is because there's an anticipation that rates are going to rise by around about another 2%. So markets have factored in that if this 2% rise happens, consumer spending, government spending, etc. will be affected massively by it. So what we're waiting to hear would be, for instance, the Federal Reserve Bank in America say, look, we're not going to increase interest rates as much as we were predicting we were going to, because it is causing a deeper recession than what we might want, or it is knocking consumer confidence so much. And if that were to happen, then markets may recover. So the next part of the presentation, we're going to look at inflation. How is inflation causing as much problems? Why does inflation cause as much problem to markets? Well, the first starting point is to say that for the last 20-30 years at least, we've lived in a relatively low inflationary environment. That's been caused a number of reasons. Government policy changed at the end of the 1970s going into the 1980s. Mrs. Thatcher and Mr. Reagan saw inflation as their biggest problem that they needed to get under control. And part of the reason why Mrs Thatcher was so hell-bent on smashing the unions in the early 80s was because unions wanted to go on strike for pay rises, and it was causing real massive problems to UK inflation and obviously UK output. So that was her agenda. By the end of the 1980s, she'd achieved her agenda, and it wasn't just the local pits and such like that were closed. There was many industries where the unions were really weakened. And that was one of the things she needed to do to get inflation under control. We then entered a 30-year period where inflation was extremely low compared to historic figures. Interest rates also came right the way down. That was mainly caused because of the financial crisis in 2008. But inflation being low helped so many things. Prices were more consistent, and people were used to having a low inflationary environment. It meant that companies didn't have to increase wages as much because, as I say, the cost of living wasn't going up as much. That's gone out of the window this year. Companies will inflate the price of their product if they know their product is in high demand. So, for example, Apple over the last 15 years have increased their price of their iPhones by around 278%. The very first iPhone in the UK cost around about £381. The 13 Pro Max, which came out end of 2021 into 22, costs around about £1,059, for example. Why could they do that? Because it's a product that the consumer wanted, and every year when they brought it out, they had new features, etc., etc. You could do this, you could do that, and people were prepared to pay it, so demand stayed there. Inflation, however, becomes a problem when it's linked to items that you want to buy to live on, and it affects your spending power. So food, petrol, etc. is the main things that's going to cause problems this year. And petrol prices, energy prices has caused loads of problems this year. But demand is going to start to come down. You're already hearing people say they're not going to take as many car journeys, etc. So on the back of that, these companies will be watching this, and price will start to come back down. Because at the end of the day, it's a supply and demand world that we live in. If demand does drop off, they will reduce price. The price over the last 5 years of Brent crude oil prices, for example, has gone up. It reached $131 a barrel at the height in 2022. Recently it was down to less than $100 a barrel. So the obvious next question for all clients watching this, if the price of Brent crude oil is coming down, why are petrol prices still remaining high? I know you might have seen a few pence knocked off in the last few weeks, but it is a genuine question. Why is this being allowed to happen? Across in the US, where their consumer are much more volatile about gas prices, it's their main thing that they're bothered about more than anything. I think a few weeks ago there was a survey done, and people were more bothered about the price of gas prices, as they call it over there, put in their cars, than they were about recent school shootings and such like. It's that much of a volatile issue that the Americans are so bothered about it that they will contact their local MPs and such like and get on the case about it. If you remember, in the UK 20 years ago we had fuel blockades and such like up and down the country when prices were getting high. It doesn't seem that people in this country are doing much to protest about it. It's just in our nature, I suppose, that we're a lot more sort of laid back about this. But I think questions need to be asked as why the oil companies haven't reduced prices at the pump a lot quicker. So the next chart you can see on the screen talks about the component price of unleaded petrol on June 2021 compared to June 2022. As you can see, the price between those two dates went from £1.29 a litre to £1.83 a litre. The basic price of petrol, as you can see there, went from 39% of the petrol price up to 54% of the price. Duty went down from 45% to 29%. VAT remains the same. But when you add up the numbers, that effectively means that on the June 2021 numbers, the government was getting roughly 79.98%. Roughly 80 pence from that, and the chart on the right, they're now getting roughly 85 pence. So governments could do a lot more themselves to bring down the price of petrol by doing something with taxes. Obviously, we were led to believe that up until when Boris Johnson resigned a few weeks ago, that Rishi Sunak and Boris were about to announce some tax cuts, and then all that's being put on hold because as I say, the Punch and Judy show that Boris was the main character and kind of came to an end when he resigned. And as I say, we now have to wait for the outcome of the Tory leadership election to find out what's going to happen next. We're led to believe that when it goes down to the final two, that the earliest you're going to hear a new Prime Minister come on board will be around about September the 5th. That upsets me massively that we have to wait another 6 weeks for someone to actually make a decision and make a move on this. It's not good. Why is nothing being done about it sooner? The other major part of UK inflation has been energy prices, gas prices. And again, on the next graph, you can see there, natural gas prices, whilst they did peak in the early part of this year, came right the way back down, jumped back up a little bit, and then they're down again. again, nothing's really happening about that, because we're still led to believe that energy costs are going to go up again at the end of the year when the next price cap comes to an end. When we look at food and commodity price indexes, you can see over the last 12 months how much they've jumped up. The price of vegetable oil, for instance, is quite stark, the one at the top, but everything else is going up as well, cereals and dairies and such like. So all of this results in not a good picture for what's happening for the UK consumers' ability to go out and spend money, is because they won't have as much money in their pocket to be able to spend, and markets don't really like that. So when we look at how a portfolio comes together and what needs to be in there, we're now looking at what asset classes are going to perform the best during inflationary times, and those are the changes that we're likely to be making. Is what asset classes are not going to do well if inflation remains persistently high. So whilst I'm saying governments are saying it's up to 9%, they're going to bring it back down, I don't know how long it's going to be before they get it back to their long-term target levels of 2.5%, especially when you look at the graph you can see on the screen now about commodity prices in the first half of 2022. Some of the prices there, the ones at the very top, have grown absolutely massively, exponentially. It's unbelievable. Very few, if anything, have gone down at the bottom. So that is what we're discussing with lots of fund managers. What changes do we need to make now that's going to make our clients' returns better in the coming years? So now come to that part of the presentation where we talk about how various stock markets and indices have performed recently. So the first thing we have to say is that it's been the worst first half to a year in many indices since figures, I don't know, early 70s. The S&P's had the steepest decline in the first half of this year since 1970. The Dow Jones has had its biggest drop since 1962. Lots of companies around the world have seen share prices drop massively. Amazon, for example, is down 40% over the last 12 months. We've mentioned on previous updates how other companies are doing. Apple are down, Microsoft are down, Facebook are down. Facebook have cut hiring by 30% with the expectation that it's the worst company the company will have seen in years. Again, I was at an event in London 2 weeks ago, saw lots of fund managers. Old fund manager there who's been around the block for a number of years, in his late 60s, said he's soon to retire. He believes we're possibly 3/4 of the way through the worst of what we're seeing now, because there's been so much overselling going on. Fear creates fear. Markets have gone down probably as low than what they should do. You look at some stock prices of companies all over the world, the UK, Europe, Asia, America, and they're massively down. The one thing, as I say, we need is the Federal Reserve to come out and say that it's not going to raise interest rates as much as it was previously feared, and that's when you should see markets turn back up, coupled up with inflation being held under control. So when we put the market indices on of what's happened over the last 12 months, the Ftse 100 still remains in positive territory. It is the best performing index of the ones you can see on the screen there now. The worst performing one we've got on there is the Ftse World Europe Index, so that's a European index excluding the UK, minus 11%. Obviously that one's more affected by what's going on in Europe. The S&P is just over 12 months just up, but as you can see from the green line there be how much it's come down this year. It's come down massively. Again, extend this over 3 years, much more positive numbers. Unfortunately, the clients who've been on board for only 12 months or less are looking at returns on some of their pension investment returns are very negative, minus 10% in certain instances. But trust the process. Over the long run, markets recover, markets provide positive returns. The S&P is still up 32% over the last 3 years. The MSCI World Index, the S&P index is up 32% over the last 3 years. The MSCI World Index is up almost 27%. The worst performing one on there over 3 years is the Ftse 100. Again, that was dragged down by Brexit fears, COVID, etc., as we've explained previously. Now stretch it over 5 years, and that S&P index is up over 68% over that 5-year period, which, as I say, if you'd been and invested in that index alone, you'd have made some fantastic returns. But the point is shown again, 5-year performance, everything will come through and those markets will come back up. So after the worst 6 months that we've seen for investment markets in number of years, you have to hope that we are now going to come out of this very soon. If you think back to the 2007 financial crash, from the point of when everything started going sour around about September 2007, everything fell down to March 2009. So that was like a 16-month period. Well, market started to turn south really in this current downturn from November onwards, so we're maybe 8 months into this. So history tells us, if nothing else, that we are halfway, 3/4 of the way, I don't know exactly, but we are possibly over the worst of the falls, and soon we'll reach a bottom point, because markets will become cheap for big investors to pile back in. Your billionaire, big huge investors will be looking at things like Amazon stock price being down so low and think, is this a buying opportunity? Other factors to consider, in the UK for example, why would our market boost back up? You're going to see more overseas companies looking to buy UK companies. The pound is really low right now, it's $1.18. So last year when it was $1.41, it's fallen by a big percentage change there. So big overseas investors will be looking at companies on the UK stock market and say I can buy them at a discount, and hopefully, as I say, that might spur share prices to come back up, as well as hopefully a new government coming in after the summer recess, get some new policies which markets will like, and we go from there. That said, I did see snippets of the Conservative candidates on ITV last night, and it just looked like a bit of a bloodbath. They were all just after each other. You can clearly see that Rishi Sunak is the favourite, because he was the one they were wanting to get at. I'm not sure who I want in charge out of them. There's been so much... as I say, it's a political punch and judy show we've had for the last few months. We just need that to calm down, and someone to come in and say, look, I've got a clear mandate, I've got a big majority, we're going to put through some good policies, markets like that, get the inflation problem sorted out, and then hopefully we can move on and there'll be positive times ahead. As ever, if any client needs to get in touch, ask any questions, please do so. We are rolling out the Wealth of Advice app. We're going to try and speed that up over the coming weeks. It's a better way for us to be able to communicate with our clients. Obviously, we do need to get a lot of data put into the new app. Previous documents are going to be shared in there. Obviously, we want the valuations to be updated and going in there a lot more thoroughly and accurately than what they were on the previous app, which we've now starting to stop use. So that's going to be coming, so keep an eye in your inbox for emails from us. Even check spam folders. We've had 1 or 2 clients who've said that an email that we sent went into a spam folder, so keep an eye on that. So finally, thanks again for listening. Enjoy the summer. I'm here in this wonderful hot office today in my short sleeve shirt. If you believe the various news channels this morning, there's going to be a danger to life with such heat out there, but really I think we should just enjoy it. It only lasts for a couple of days. So thanks again.